If I were an agent, one of the things I would be doing is finding resources that will allow me to target and identify borrowers in the very early stages of foreclosure to help them sell their property before they lose it to a foreclosure auction.
Hello, agentpreneurs, and welcome back to the Daily List Report. As you saw in the opening there, we have back on the show Rick Sharga. Rick has been on multiple times developing a competitive advantage, 2020 versus the Great Recession. That was a good one. Work from home's impact on real estate. Rick is an executive vice president at realtytrac, and this guy has been everywhere on every news channel. He's just a frequent speaker and an industry expert, and I love my conversations with him, and he brings a lot of value. And so today we're going to talk a little bit more about the foreclosure market and what's happening there, what opportunities may exist. What's interesting is we all know ad nauseum that there's no inventory. And actually what's interesting about that is that there's a lot of homes that are selling. There's a lot. And by some estimates, we might sell north of 7 million homes this year. And that's a massive, massive number. But it feels like there's no homes. Days on market is down. Things are moving very quickly. It's a very efficient market in some ways, but it's leaving a lot of people out in the cold. So we're going to talk about foreclosures a little bit and see if there's any opportunities there. So without further ado, let's bring Rick back on the show. Rick, welcome back to the Daily List Report.
Thank you, Randy. Always a pleasure to speak with you.
Likewise. Thank you for taking the time. So Rick, this is an area I know you know a lot about, the foreclosure market. And, we'd be curious to get your perspective. Why don't we start here? And this is how I feel like every conversation these days starts, right? But there's not a lot of active listings right now. Listings are flying off the shelves. We're going to sell a lot of homes this year. And I think that's the thing that's a little bit confusing about how you look at the market here. Why don't we start there before we get into the foreclosure topic? Talk a little bit about, from your perspective, what's happening in the market. Is there anything that's going to make this better? Kind of what's happening from an inventory perspective?
Yeah, there are two things that are likely to make it a little bit better, and both of them, unfortunately, are going to take some time. We have seen the builders start to build in earnest. They have some headwinds. Materials costs are very high. It's hard for them to find skilled labor. It's harder for them to find land that's available to build on right now, especially with some of the regulatory hurdles some states put in their way. But the last housing starts numbers were very encouraging, much higher than we've seen in quite some time. So ultimately, the builders who have been largely responsible for the lack of inventory have been underbuilding for the better part of a decade. They're going to have to help us build our way out of it. The second thing that will help is that I really do believe there's a psychological barrier to people listing their homes for sale. And as much as we like to blame the builders, keep in mind that normally between 80 and 90% of all home sales are existing home sales. We've had people just staying in their homes longer and longer. I think the average tenancy in a house right now is about 12 years.
Wow.
5 years ago, that was only about 5 years. So it's really expanded pretty dramatically. And I think people are hesitant to put the homes on the market for two reasons. One is they're not sure there's anything for them to buy if they sell their own house. And the other is the COVID-19 pandemic. People are a little leery about having strangers in their homes for open houses. They're a little leery about going into a stranger's home themselves. So I think as the pandemic feels more like it's under control, as more people get vaccinated, as the numbers go down, you'll start to see some of these homes come onto the market. So those are the two things that I think will ultimately bring the market back to a level of equilibrium. We're, by my estimates, probably about 2 million listings shy of where we would normally be this time of year. And the demand is higher than normal, so it feels even worse than that. My counsel for anybody who's waiting for the foreclosure market to make up that supply of missing inventory is don't wait.
Yeah, it makes a lot of sense, Rick. I was listening to, I think it was a CNBC talk with the CEO of Century 21, right? Just to your point of inventory. And he talks about the 3 L's, right? So laws, lumber, and labor, right? And so I think to your point, the laws around, like you said, it's hard to find land. And that requires, I think, in some markets, some changes. Lumber, like you said, we've seen, inflation and the building material cost has gone through the roof. It's been extremely expensive. And labor's been compromised, right? Not just because you need a lot of people to build more homes than we've built, as you said, in a decade. But also, the pandemic over the last year has probably compromised that as well. So it's really kind of a perfect storm of us not having enough inventory. And what's interesting, I think, Rick, and just curious to get a quick take on this, is that this is different than a recession, right? I mean, very different. And what we've seen over the last year is all of these millennials who, I think home ownership is now up in the 47%, from 40% over the last few years. And this is the largest demographic of buyers. People that, probably when we met, Rick, years ago, we thought might never buy homes, right? That's what everybody thought. And it certainly isn't the case. And so it's, how are we going to build affordable housing? I mean, that's for a starter home. That's a huge problem, because builders, if you're going to build right now with all these costs, you're going to build some nice places.
The builders are up against it when it comes to affordable housing, and that is one of the biggest challenges in the industry. According to Fannie Mae, it costs a builder about $80,000 before they break ground on an average home. In California, that number is over $100,000. So if your table stakes are $100,000, it's really hard to build an affordable house. And that's just the reality we're dealing with. The fact of the matter is, I think we're seeing the work from home movement actually help this situation a little bit, because people can now move further and further away from urban centers, which are the most expensive areas, into less expensive suburbs and exurbs, and even into rural areas in some cases. So the cost of their homes can go down a little bit the further away from the urban areas they get. But it's a real challenge. The Biden administration is earmarking billions of dollars to try and incent states and municipalities to make it easier to build affordable housing. They're earmarking money for public-private partnerships, which would actually incent builders to create more affordable housing units. But the reality is, it's a really difficult problem to solve. And I think whatever inventory the builders can bring to market will ultimately help. Even if it's a mid-priced property, that theoretically frees up a lower priced property, because the move-up buyer will buy that more expensive house.
Yeah.
And one of the problems we have right now is nobody is selling those less expensive houses, and the builders aren't building them. So again,
Absolutely.
to your point earlier, it's kind of a perfect storm.
It is. It really is. So let's talk a little bit about foreclosures, right? If we think back, Rick, to when we were talking, a year ago almost, there was a lot of questions. Certainly, we had no idea what was going to happen. So let's get a quick update on that. Let's get an update on sort of the moratoriums that I think had been planned to be lifted in the June-ish timeframe, and just what are you seeing in terms of forbearance requests and things like that?
So the bottom line is that foreclosure activity has been ticking up slightly over the last couple of months. And our read on that is the reason the numbers are going up is because some states are now making it possible for lenders to foreclose on vacant and abandoned properties. And that's good. That's good for neighborhoods, good for communities. Vacant and abandoned properties are always a safety hazard and an eyesore. During a pandemic, they become even more of a safety hazard, because who knows who might be squatting in those houses, and you could have pandemic related issues. So I think the states opening up the door for some of these foreclosures on vacant properties is good. That said, we're still running at about 80% below year ago levels of foreclosure activity. And last year, entering the pandemic, foreclosures were already running at about half of the normal rate. So very strong loans, a lot of equity, record levels of homeowner equity. The pandemic moratorium was supposed to end last December. It's now been extended through the end of June. I'm almost positive it will be extended through the end of September at this point. The Forbearance Program, which was scheduled to stop in March, had another 6 months added to it. So people that are in the Forbearance Program and are able to skip their mortgage payments temporarily have another reprieve. But what I will tell you is this, that the number of people going into forbearance has continued to go down week over week, really since the program peaked back in late March a year ago. So almost nobody's entering the program right now. And the people that are exiting are doing so extraordinarily successfully. 88% of the people who left have left either by having their loans reinstated, by continuing to make payments, by entering a loan modification or repayment program with their lender.
Wow.
And even the people that aren't leaving don't appear to be going delinquent, because even as people have left the program, we've now had 6 consecutive months where mortgage delinquency rates have gone down every month. So for all of the headlines you read about serious delinquency rates being so high and millions of people being in danger of foreclosure, the numbers suggest just the opposite of that. The numbers suggest that the people who are the volume of people who are um, in trouble, who are potentially in distress, might be vulnerable. That volume continues to go down, and the people that are returning to normal payments are doing so very, very successfully. And that's why, Randy, I don't believe that what we're seeing suggests we're going to see an influx of massive numbers of foreclosures anytime soon.
Yeah. No, Rick, thank you for that perspective. It's pretty amazing, isn't it? Right? Again, I think back to the conversations that we had and I've had with others. Rewind the clock basically a year ago, a little more than a year ago now, and it was potentially cataclysmic, right?
Yeah.
These
Yep.
lenders did not write plans that had this many people, in a forbearance program, and we didn't know what was going to happen. And the industry really, I think, rallied, and a lot of things, worked out quite well. And so to hear you say this, I think is fantastic, frankly, that most people have come out of it. Did it turn out to be the case that a lot of people preemptively entered a forbearance program even though they had jobs? They didn't necessarily need it. And I'm not saying that they were being disingenuous. They just didn't know what was going to happen. Did that turn out to be the case?
Well, let's not sugarcoat it. Some people were disingenuous.
Sure.
There's always a percentage of people in programs like this who see an opportunity just to not make that monthly mortgage payment for some extended period of time.
Yeah.
And it wouldn't surprise me even a little bit to find out that one of the factors leading to record level of savings rates in the country are the people who are putting that $1,500, $2,000, $3,000 a month into the bank instead of sending it to the lender. But it's the way the program was set up. LendingTree did a survey early on in the forbearance program, and concluded that about 70% of the people in the program didn't necessarily need forbearance, but the majority of them had opted in as a just in case scenario. They weren't sure how stable their jobs were because of the pandemic, and wanted to take advantage of the protection if it were available to them. So they did. And I know a lot of those people have been the ones who have exited. Surprising percentage, somewhere between 25 and 30% of the people in the program who have exited never missed payment, even though they were in forbearance.
Wow.
So yes, that really is the case. And look, we can't sugarcoat this. There were 22 million people that lost their jobs.
Yeah.
We've recovered between 60 and 65% of those jobs. Most of the jobs that were lost by renters. They were lower paying jobs in industries that typically hire people without more formal education, people that are younger workers, people that are making lower wages, and they're disproportionately renters. And that's one of the reasons the housing market hasn't been impacted as much as you'd expect. But because of the eviction bans that are in place, protecting a lot of those renters, there are a lot of landlords who are susceptible right now. And I would not be surprised to see a spike in foreclosures and bankruptcy filings by landlords who can't evict a tenant who's not paying and can't afford to continue fronting the payments themselves when they're not collecting rent. We're already starting to see incidents of those landlords selling off their properties. We're also going to probably see some fallout from FHA borrowers. So if you look at the delinquency rates, FHA borrowers are running 2 to 3 times higher than everybody else. FHA borrowers typically have less equity because they put lower down payments on their properties. They typically have higher debt. They typically have lower cash reserves. Those are the borrowers. So if you're in a market like Atlanta or Tampa or Orlando, Chicago, areas with a high percentage of FHA borrowers who are delinquent, you might see a spike in that kind of activity. So there are areas where we'll see vulnerability. The third one would be low dollar value commercial properties. The commercial market got slaughtered during this recession. Retail and hospitality in particular. So you could see a lot of limited service hotels. You could see a lot of small retail outlets going into foreclosure. And honestly, in our realtytrac database, we're already seeing 5 times the normal number of commercial foreclosures with loans of $5 million or up. Now, I don't say that to be alarmist. That means
Sure.
instead of seeing 10, we're seeing 50. So it's not a huge number, but it's still 5 times the normal level. And so that does suggest that the commercial market's been hit a lot harder than the residential market.
Absolutely. But what's interesting when you talk about the FHA buyers, the home prices are just going through the roof. They just keep increasing, and so their sort of equity position, in a sense, is getting stronger. It seems like day over day, and that does create other opportunities for them, hopefully, to mitigate some of that.
That's offset a little bit. And by the way, I've been preaching that for a year now, that equity is crazy. Even before the double-digit monthly price increases we've been seeing, equity was at a record high. It was $6.5 trillion 6 months ago. And that's another reason we won't see a ton of foreclosures, because borrowers with equity, even if they're financially distressed, have the option of being able to sell the property, providing needed inventory in a market where we have that huge supply-demand imbalance, and they'll walk away with money in their pocket. It's more of a traditional sale. So if I were an agent, one of the things I would be doing is finding resources that will allow me to target and identify borrowers in the very early stages of foreclosure to help them sell their property before they lose it to a foreclosure auction. The iBuyers, by the way, are going to make hay in this market if traditional agents don't reach out and help these sellers early on. But the thing that offsets a little bit what you're talking about, Randy, is people don't realize that interest is accruing. So even though there's no more principal building up on the loans that the FHA borrowers owe money on, they're going to have an extra year of interest to pay. They're going to have an extra year of insurance and taxes to pay. And in some cases, that completely offsets the increase in the value of the property. So we'll see how that all plays out. But to your point, this is not the last recession. This is not where prices fell 35% year over year and 30% of borrowers were upside down. Nothing at all like that. So even if the balance is a little off with these FHA borrowers, they might be able to execute a short sale with only a little bit of a deficit compared to the problems they had last time around.
Yeah, no, that's a really good point. In that you said $6.5 trillion in equity, right? I mean, what a different position than we were in a decade ago, or I guess more than that now. Last question for you, Rick, as we wrap up today, because it does speak to what you were just touching on this, right? If I'm a prospective seller right now, there's the obvious concern, which is, okay, I know I can get top dollar for my house. That's great, right? But where am I going to go? As you look at sort of the balance of this year, knowing that there is this much, equity in the market, knowing that this isn't the same as it was before, and again, going back to this video from the CEO of Century 21, he's like, it's not a bubble because there's real demand and there's no inventory. This is a very different situation, but it's unaffordable for so many people. What happens to prices as we look in, use your crystal ball here, Rick, as we come into the end of 2021? What happens to home prices?
Home prices are going to continue to go up until the inventory comes back. Look, we're going to hit an affordability wall at some point. Even though we're at record levels of prices, most parts of the country, your average mortgage payment is lower than it was a year ago because interest rates are so low. So the combination of wages, generally speaking, going up, at least among the home buying cohort, and interest rates being at historic lows so far has offset the extraordinary increase in home prices. That math doesn't work forever. And interest rates simply don't have further to go down at this point. Not in a meaningful way. So at some point you hit an affordability wall, and we may be seeing that in markets like Austin, like coastal California, like Seattle. So a handful of markets where prices have probably gotten out ahead of what the buyers can really handle. But this is not a bubble. Could we see some price corrections in certain markets, particularly in certain price tiers? Absolutely, we could. But until we see either inventory start to come back in a meaningful way, or, and this would be the more negative way of looking at it, or we see interest rates tick up maybe by a point. Either of those things could slow down demand, and slowing demand is ultimately what will bring prices back to a more normal rate of appreciation.
Yeah, well said, Rick. Yeah. It's wild times, that's for sure. Rick, is there anything else you want to add before we wrap up the show today?
Yeah, there are agents who've traditionally participated in the distressed market, and typically they've waited for the lenders to repossess the properties and then got listings of what are called REO assets, REO homes, bank-owned properties. My urging for anybody who's expecting that kind of market is to rethink your priorities. This foreclosure cycle is going to be very different than the last time. I think very few properties are going to ultimately go back to the lenders. So this is a good market to be working with those home buyers, sorry, owners who are financially distressed. Get those listings before the iBuyers do, because the iBuyers will at the last minute they'll swoop in and get those properties. Um, you're also able to work with investors who are buying these properties at auction sales, and a number of these properties will go to the foreclosure auctions. But don't wait for those REO assets to be the bulk of your practice, because they're just not coming this cycle. It's a very different dynamic in the marketplace. And at the risk of being hopelessly self-serving here, that's how a lot of agents use our site at realtytrac, is to identify those off-market opportunities. So if anybody has any questions about that, feel free to reach out, and I can certainly answer any questions people might have.
I think that's great, Rick, and I think that's great advice. And everybody listening right now should absolutely do that, because there's some great opportunities there to, frankly, to help somebody and to get a property, on the market, which is much needed before somebody gets into too much trouble. Rick, I lied. I do have one more question, because you just sort of touched on this, which is the iBuyers. And, just sort of looking at this rationally, right? It seems like, generally speaking, this is going to be a tough time for an iBuyer. Because why would I, as a seller, want to just take your one price when I'm seeing now, and you've seen the data like I have, right? Homes are selling over asking, right? Those ratios are way out of whack, and it's not 95% of it, it's like 106%, whatever the number is, right? So why would I want to sell for one price when I could put it on the market and I can get, dozens of offers and go over market?
For 99.8% of the population, the answer is you wouldn't.
Yeah.
So the market conditions over the last year, first of all, the iBuyers all basically closed up shop when the pandemic hit.
Right.
For a whole variety of reasons.
Yep.
A strong seller's market like we have now, and this is an historically strong seller's market, is the worst possible scenario for an iBuyer. The iBuyer value proposition is certainty of sale and speed of sale.
Right.
But you're paying
those both exist without them in this market.
and right. So you're selling a property in 9 days instead of 90 minutes, but you're getting 108% of list price as opposed to 90%. So it's a terrible time for the iBuyers. That said, once we do start to see some distressed inventory, even if it's early stage foreclosure before the property is listed, the closer you get to that foreclosure auction, the more attractive that iBuyer value proposition becomes. If you're scheduled to go to auction in 3 days, even in today's market, that doesn't give you enough time to list with an agent and sell the property. But an iBuyer can come in and write you a check that day. So I do think, as we see the forbearance program and the foreclosure moratorium end, those market conditions will play right into the hands of the iBuyers. And that's, again, why I'm encouraging agents to get out in front of this early. Reach out to those distressed homeowners early in the process, and help them get top dollar for their house, so they get a fresh start with money in their pocket. Rather than and the agent gets a listing and a commission, as opposed to losing it to an OfferPads or an Open Door or a Zillow Offers, which is, I believe, really what will happen in a lot of cases.
Yeah, no, it makes perfect sense. Rick, thank you so much for taking the time to come on here and to share your amazing perspective and expertise, with all of our agentpreneurs out there. I can't tell you how much we appreciate you.
I appreciate the opportunity to talk to you and your audience, Randy. It's always a lot of fun.
We'll talk to you real soon, Rick.
All right, take care.
So there you have it, everybody. I think that was a great overview on what's going on in the market, what we might expect coming into the end of the year. A lot of the same themes here, but I think Rick really hit the nail on the head, which he said, look, there's an opportunity right here. There's something like twice as many agents than there are active listings right now. So it's a weird market. And so if you look at this as an opportunity and you can leverage a service like realtytrac to identify some of these properties, and you can create a great outcome for that homeowner who's in trouble right now, and for yourself. And I think that that's a win-win. So really great advice from Rick. That's it for today. Until tomorrow, be safe, be healthy, be happy. We'll talk to you soon. Bye.